Hello everyone. Do you want steady income from Bitcoin? Here in this video, I'll show you practical delta neutral option selling strategy where I'll explain how I start with 20 delta Strangle, then how I'm making disciplined 30% move adjustment, also drifting the position towards a straddle, and also protecting profit by converting it to an Ironfly. So here you will learn entry selection, when to make adjustment, how to hedge, and also simple profit booking rules so that you can generate consistent premium income while managing your risk. So let's get started.
Hello guys, in this video I'll explain how we can use a delta neutral strategy in Bitcoin option selling. So here this video is about option selling and I will explain how we can generate consistent income from option selling in Bitcoin. Okay, so that's the agenda of this session. So before we proceed further, we use the strategy normally in equity. Okay, and we also use this in indices also. So this is basically a delta neutral strategy. So we keep adjusting the position as and when Bitcoin move, or as and when the equity move, or as and when indices move. So when you're trading Nifty and Bank Nifty or Sensex, or for that matter any other indices that you are trading like S&P 500, we follow this delta neutral strategy. And here what we are going to discuss is also modeled on the similar line, right? The equity, the way we trade, it's basically zero DTE style. So we have discussed, if you have attended the course or if you are following me, I've discussed a strategy like 0 days to expire strategy. For example, if you are someone who's trading Nifty, then the strategy that you deploy on Wednesday, or you come to the market on expiry day morning, like on Thursday. Earlier it was on Thursday, now it's shifted to Tuesday. So since I've already discussed this in the context, I've taken this reference. So either at Wednesday 2 p.m. you will implement the strategy, or Thursday at 9:20 a.m. you will implement the strategy depending upon the risk tolerance. So exactly in the similar way we are going to use this Bitcoin, right? So here the strategy is very simple. We are going to capture the time decay. The 1 day to expiry means, so the one contract that you see here, this is 1 day to expiry. So when you look at Theta exchange, so here I'll be showing the Delta exchange and I'll give you the link also in the description. So if you want to open an account in Delta exchange, you can use that referral and you can open the account now. So here you have 0 days to expire. So as you see here, the timing will be from 5:30. So 5:30 p.m. this contract will start and the expiry of this will be at 5:30 p.m. next day. So you can see here 7th, if I am doing this video 7th of September. So 7th of September 5:30 p.m. the contract is beginning, and 8th of September 5:30 p.m. this contract will expire. So this is 1 day contract. Now multiple contract is there, but the strategy that we'll be using is the daily contract, because the theta, the time decay, will be higher in this case. So we are trying to capture the time decay that we are getting from this 1 day expiry. Now the advantage with Bitcoin is the premium is so high. Bitcoin is so volatile. So IV is also playing a bigger role here. So the premium is so high. So if you look at Bank Nifty on expiry day, you may be getting premium like, you used to get it like 150. So you get the premium like 150 if you come in the morning and see the Bank Nifty on expiry day. But I will show you here Bitcoin at the money. You look at, so I'm talking about the money premium as 150. Nifty will be like even much lesser. So Bank Nifty is trading at 50k, right? So look at this, 150 is what we normally see on expiry day. And now if you look at this is a 50 delta. So look at this, 530 and 600. So here also 575 and 550. So this is what at the money. Any of this will be at the money, because now it's trading at around 1,11,300 levels. So these two can be at the money looking at delta. So here for call this is at the money, so you can say for put both are very close, so both are in fact we can say slightly at the money only. So look at the premium, it's around 530 level, so that itself is showing you 530 is the premium that you are getting, which is almost 4 times of Bank Nifty. Now you need to compare it with the index also. This one is trading at 1,11,000. Bank Nifty is trading at 555,000, right? So here, if it is 55,000, this is Bitcoin is 1,11,000. Of course, this is 2 times. So the premium, which is 300, is perfectly okay, right? Compared to that, but here you are getting almost 4 times. Now again, you need to remember one thing. Sometimes this 150 is 100 also. Sometimes 125 also in Bank Nifty. But one more thing is there. Now there is 24 hours in Bitcoin, but most of the cases we are talking about on expiry day in Bank Nifty. But ultimately the point is you have good premium here. Okay, now the question is, what is strategy? The strategy is we are simply going to go with this triangle. So expiry day strategy is very simple. What we do is you decide the level normally that Nifty won't cross on the upside, or Nifty won't cross on the downside, or Bank Nifty won't cross on the upside, or it won't cross on the downside, and then you will sell that call and this put, right? So this is what normally you do. Or if I want to simply generalize, I will go with something like 25 delta on that call, and then 25 delta on the put, and then I'll sell it. This is what I do on expiry day in Indian market. Similar thing is what we are going to do here. So here, instead of this 25 delta, I'll be selecting anything between 16 to 22 delta, okay, depending upon the premium. So anything between 16 to 22 delta I'll select. So assume I'm going to select 20 delta. Okay. So we'll look at the examples and then you will understand. So when I say 20 delta, here you can see delta value is 20, and I'm getting a premium of around this range around 160 I'm getting, which is crazy good at 20 delta. And here if you look at the call also, I'm getting around 173. Okay, so that's also very good premium. So I hope you got it. What I mean by 20 delta, you can see here, or sometimes 18, I told you 16 to 22. So here either I can go with 18 delta or I can go with 22 delta. Similarly, here also I can go with 19 delta or I can go with 23 delta, and any of this I can go with. So my point is, I will select approximately 20 delta call and similarly approximately 20 delta put, and both of them I will be selling. Clear? So it could be 19, it could be 22, no issue. Here also, when you watch this, you will understand it could be 18, it could be 22, any of this. Let's say I'm taking this. So here, call I'm getting approximately 170 premium, and put also I'm getting approximately 170 premium. And combined, I'm getting 340 as my premium. So I got 340 premium. $340. Okay, so this is what I'm getting. Now here there is no protection, there is nothing but a simple strangle. So I start with a strangle. So the step will be like this. I start with a strangle with 20 delta call and 20 delta put, right? And then what I do is I slowly adjust when I see 30% move on any one of the leg. So adjustment will come. So I'll be discussing this adjustment also, adjusting when 30% change will come in any of the leg, and slowly you will be progressing from this 20 delta to 50 delta. So at one point you will become, you're progressing to, you're drifting this triangle to straddle. So when you keep doing the adjustment, ultimately what you're doing is 20 delta, you're drifting to 50 delta, which means you're drifting a strangle to a straddle. So now once it comes to strangle, then you will buy the hedge on both ends, and then you will convert this to Ironfly. So this much is what you need to understand in this video. So what I just told is, with only the strangle part. Now, when we proceed further, I will have to explain how this adjustment is done. What do you mean by this 30% change, and when the trigger will come for adjustment, and then also I will have to discuss when this become a straddle, and once it become a straddle, will you again tolerate if it goes to 60 delta, 70 delta, etc.? No, of course you will never keep anything where it is going to ITM. Okay, we won't tolerate that. That's why when it become a straddle, when you drift it to a straddle of 50 delta, you'll convert this as Ironfly. So you will secure it with hedges. So this is the strategy is all about. So let me explain it further. So as I told you, this one that I am looking for, so you can see here the premium is around 200. Can you see it very clearly? So I'm getting 200 premium. Now you're going to get almost a similar premium the other end also, right? So here let's say either this one, but assume that you are going to it's 180, but assume that you're going to getting that you are getting almost 200, right? So sometimes here this is 0.23 and 0.22. So if both are coming to 0.23, you will get that. If both are coming to 0.22, so you will get almost equal premium, right? So here assume you got 200 and you got 200 and you collected 400 as the premium. So what is this? This is nothing but 20 delta. Now what will happen? You will have to do adjustments based on the move. If there is not much move, then there is no problem. But Bitcoin is so volatile, you keep getting the moves and you need to be prepared, because at any point of the time, the big moves can come. So 20 delta, it moved to 50 delta. When you keep doing the adjustment, so what will happen is this triangle that you started with will become a straddle. And this straddle you will buy the head. Once it become a straddle, when it is strangled at 20 delta, at the 30 delta, at 40 delta, then there's no hedges, no protection. It's plain open strangle. Once it become 50 delta, or once you make it as a straddle, or once it reaches at the money, and then you will buy the hedge, and then you will convert this to Ironfly. So this is what we are going to do. Now let's see what is supposed to be done. Okay, so let's talk about that. Now let me erase this. So guys, so we have started off with 20 delta called 20 delta put, 20 delta call, 20 delta put. Okay. Now we have started off with 200 rupee premium. Now I told you 30% change is happening. So what's 30% of 200? Which is nothing but 60. Which means any one of the leg going to 260, it could be call or it could be put. So once it reaches 260, that's your trigger for adjustment. So one reached 260, so what you're going to look at is the other. If call reached 260, put might have reduced from 200 to something like 120, 130 or sometimes 140 also, depending upon the time also it took. So if it is 130, so one is bounced 60 points, the other reduced to 70 points. So you are making a loss of 60 in this, but you are getting a profit of 70 in this, and net your profit only 10-point profit, because time decay is in your favor. So here what you will do is this leg that is giving you profit, you will exit. This you will exit. So you started off with 200 call and put premium. Now this went to 260, the other came down and this is showing profit. So you exit this. Now what you have, this one you have, right? Now equivalent to this, just like here both were almost equivalent to this, suppose this is called, you need to find another, it could be 260 or 250 or 270 range, another opposite leg you need to find. So if 260 call is pending and you exited the put in profit, then you find 260 put. Okay, so go to that strike price where you're getting 260 premium or 250, 270. I wanted it in this range. So this is going to be 260, which is there. So you exited this. Now you're going to sell another put which is equivalent to this. So what's actually happening? When you started off with 200, it was 20 delta. Now 30% increase. This might have become 30 delta now. Right, both are now 30 delta. So one, you exited with slightly small profit. Now you are entered into another position. Now what can happen? Either of which can move higher, right? Either the call will go higher again, another 30% it will move, or this will move another 30%. So what do you need to do? Simply the one which moved 30%, what is 30% of 26? It's going to be around 80, approximately 80. So 26 plus 2652 plus 2678. So approximately 80. So actually 78 but approximately 80, which means anything moves to 340. This is the next trigger for you to make adjustment. So next trigger for you to make adjustment, what will you do? One move to 340, the other, this one may come to 260. 260 may come to 180 or 160 or 170. Here because of the time you get some profit. So what you do is the one which came down you exit, and now you have this one with 340. So what you need to do now? Similar process what you have done before. So let me explain this once again. Initially you started with 200 and 200. One moved to 260, the other moved to 130. So what you did? You exited this one and you added with another 260, the same equivalent of what is pending. It could be on the call, it could be on the put. I'm not making it confused. Okay, so assume like this is call and this is put. So what you exited the put and you added the put. So this is call again. It could be on the other side also. Then what happened from here? Let's say this one moved further, that means reversed. Okay, it could be a reversal. So this one or anyone is moving further, and then what happened? Another 30%, which is 340. So 30% change here and then another 30% change here, or it could be anywhere. So what will happen with this 250, 260? It will become 170. So what will you do? You will exit the one which became 170, and then you will be doing with the similar process like what you did here. So here it is 340. So now add the one with 340. So initially when you started with this, it was 200. Both were like 20 delta. Then it became 260, which is almost 30 delta, and now it became 340. Now it's approximately become 40 delta. Now what will happen? Again any one of this will bounce, right? Again any one of this will bounce, and what is 30% of this? This is going to be 105. 30% is going to be 105. So 35, that is 105 precisely. It is 102. Okay, let's keep it as 100 because 34 multiplied by 3, it is 102. So since earlier we have added here, we'll take it as 100, which means 340 become 440. So assume this become 440. Now what happened with the other ones? The other one will reduce maybe 110 or 120. So this would have become 230. Now what you need to do? Whatever have become 230, you will exit. Now look at this. This is 440. Add 440. You may not get exact 440. It could be 430. It could be 450. It could be 425. Whatever it is, it should be very close. That's what I mean to say. So you will add that, and then this could be 50 delta. So now look at 50 delta here. If you see, did 50 delta around this range. Okay. So 50 delta, not at reach 50 delta, you can see it may be 45 delta. So one more move, it can reach to 50 delta. Because you look at the premium, this is it's around 500, 550 level it's coming. So here you can also see 500 level. So here we are now close to 50 delta. So the moment you become like 50 delta, what is happening? Now this is going to be a straddle. So straddle means like you're getting 500 and 500 or 550. Look at this. This is around 5575, which is 0.51. And if you see here, 0.48, 530. So approximately 550 and 550. And you're getting 1100 premium here. So this is straddle. So you started off with something with 200 plus 200, which was a strangle, which had 20 delta. Now you reached to straddle with 50 delta. That time 400 was the combined premium, Now if you look at it, it's around 1100, and now the move will be so fast and volatile. So initially, why we are starting with 20 deltas? Because here if you see the premium is less, right? Because you can see here the premium also not much, and you get the time for adjustment and you can manage in between. So now it's going to be super fast moves. So what you need to do is, see, you need to look at where this is standing and then 1000 point move, 1000 point above and 1000 point below. You need to buy the hedge and or wherever you're comfortable. Now you need to buy the hedge. You need to buy both call and put. And when you're doing that, what you're actually doing, you're converting this to Ironfly. So what does Ironfly means? Suppose you sold a call, you sold a put approximately at 500. So you're selling, so I'm keeping it minus. Then what you do? You'll be buying a call, you'll be buying a put. So this is plus. So here maybe premium of 50 or 100 you're paying. So this is what Ironfly is all about. So once you drift the Strangle to Straddle, that means 20 delta to 50 delta. Now you need to protect it. You need to secure it. That means you need to buy the hedge and convert the straddle to heads. Now the profit booking. Guys, to be safe, use initially itself, once the first move is happening, you're getting some $10 profit because of the time decay. Similarly, in my opinion, when you start getting around $50 profit at one point of time, that is where you can safely exit. Don't wait for full premium decay. This will be the big issue. Never ever wait for full premium decay. Exit when you get $50-$60 safely, so you can keep getting that 3%, like that small percentage, and it will gradually and slowly accumulate and will give you good return over a long period of time. This is how compounding will work. So get that small return, get that small percentage, right? This is modest without much risk, and you understood the adjustment. Don't even let it reach till a straddle. Rare cases it should go to straddle, but before that itself you book that profit, simple small profits, and it should be done for the day easily. Now here you can go with the strategy builder. You can see the charges and you can see how much capital required and everything. It will be very easy. So I'll share the link of this Delta exchange. You can open there. You can see multiple options. This is 8th of September. This is what we discussed. So everyday options is there. You can now work on this. So that's about this session. Thank you so much for watching. See you in the next video.